Do you wonder if your stocks are going to go up? Do you feel like you have to have your stocks go up in order for you to have enough money to retire one day? In this video, I'm going to share with you something that will really help you have a better feel for if your stocks are going up or down and when that's going to happen. Hi, I'm Camille Gaines, and I share here what I've learned from investing for almost 40 years now and from creating multiple income streams. I write about this at retirecertain.com, and I talk about it here on my channel. In this video, I want to share with you something that is so incredibly logical that investors miss when they think about if their stocks are going up or down. And that is the biggest influencing factor on stocks. Now, it's not necessarily so much about whether you've chosen a good stock or a good stock fund, or whether you have a financial advisor that's picking the best stocks or wealth manager that's picking the best stocks for you. It's more about what's going on in the overall market. And the overall market is a factor of what's going on in, we all hated it in high school, but it's true, it's the economy. And there's just some really good basics here. And knowing these good basics is going to help you have a really good feel for whether or not your stocks are going to go up or go down over a certain time frame, and just help you reduce your risk a little bit when you need to reduce your risk a little bit, and maybe be a little more proactive with your investing at times when you can be, so that you can build wealth faster. So the first thing is that stocks tend to go up when companies make money, right? The stock market goes up because companies are making more money. That's just so incredibly fundamental, but we forget it in like all this, talk about investing and all the information that comes with it. So stocks make more money, and when companies make more money, rather, that issue stocks, but companies make more money, and when they do, more people want to own them, and that drives up stock prices. Okay, number two, companies tend to make more money when the economy is growing. Okay, so first there's the economy and what it's doing, and then it's whether or not stocks are going up. Remember, it's not just about an individual stock or a handful of stocks or your portfolio. It's most stocks move with the market as a whole, and the market is heavily influenced by what's going on in the economy. The economy's growing, stocks are making more money, companies are making more money rather, and that affects their stocks, so stock prices are generally rising. Time is off a little bit, but that's kind of the big picture of what's happening that influences whether or not stocks are going up or down. Three, the economy goes through cycles that are pretty predictable every few years. And the economy grows, and then it stops growing. And then it grows, and then it stops growing. And the Federal Reserve does things to sort of manipulate this a little bit to try to keep things, somewhat sane, but that's how it works. There are cycles. So it's like, wow, okay, well, if I know there are cycles, that I hear predictability in that, right? So if we know that this is happening and it's happened over and over and over in history, we can look at the past and use it for our information today to help us make good decisions about investing. Now, nobody knows exactly when those cycles are going to, begin and end, and there's some tweaking, but there are sure some very, very clear signs and data that are easily available for free that you can use to have a really good idea. Now, let me just mention that since 1945 through early 2010, the average growth cycle was about 5 years, almost 5 years, okay? So you can kind of use that as a gauge, although, a lot of cycles, there can be a lot of variation in that. But if you say, well, gosh, we're in year 10 of a growth cycle, that seems really unusually long, because what we have to remember is with investing, everything goes back to the mean, the average. It goes back to normal, okay? Number four is that companies make less money when the economy slows down. That's because it's harder for people to get loans. It's harder for companies to get loans. It's also harder for people to stay employed. It's harder for companies to sell their goods because things have slowed down and people aren't making as much money. Jobs aren't as available. That's number four. That all makes sense, right? All this makes sense. And then number five is that almost all stocks drop in relation to a recession. Again, the timing's off a little bit. It takes a while for the economy to play out in the stock market, although the stock market does react very quickly to changes in interest rates and what the Fed's doing to manipulate these interest rates, economic cycles. So once you know this and you apply that to your investing, instead of going, well, I'm really, worried, or fear and greed play out in our investing, been there, done that. If we instead look at data and we look at history and we use that as logic to make our investing decisions, we can really, really become empowered investors and make really better decisions about our investing. That's what I wanted to share with you in this video. I write about this at retirecertain.com. I wrote an entire article on this, and it's got all kinds of nerdy stuff that I like to talk about over there. So come see me. If you like this video, click the thumbs up button below, please. I'd love to know it. And subscribe to my channel if you like my videos. Thanks for watching.